I see two narratives: total doom and gloom, markets collapsed, buyers don't want to buy, sellers can't sell.
The market's not more of the same. Sales are starting to pick up.
That's a big positive for buyers, especially those that are just entering the market or upsizing.
We haven't had a market like this in 20 years that's been sort of this slow from a sales perspective for this long.
People seeing their property values go down 5 to 10% on their assessed value.
It's an end user market right now. So selling a vacant condo versus a tenanted condo to an end user, the vacant condo is much easier for them to take possession of.
Bitcoin, Labubus, stock, real estate, people, they sort of like to join that herd.
Welcome to the Rennie Podcast. I'm Ryan Berlin, Vice President of Intelligence and our Chief Economist here at Rennie.
I'm Ryan Wyse, Market Intelligence Manager and Lead Analyst here at Rennie.
And today we have a high-profile and well-dressed guest, a returning guest, a longtime Rennie advisor, one of our highest performing advisors, a Rennie leader for how many years?
I don't know. Probably since they started Rennie Leaders, maybe.
20 years. Medallion Club for how many years?
I've been here 16.
Well, then it's been 16.
Yeah, Medallion for around 10 or 12, I think. Yeah.
Presidents?
Couple. Till they changed the rules with the teams.
Right. You're also an art collector.
Yes.
What else do you do? Do you adopt rescue
Lots
dogs?
Of golf.
Lots of golf. Yes,
Oh,
of course. Are you lefty or righty?
Righty.
Good.
Okay.
No golf until at least April, though.
And
It's coming.
Snowing today.
It's snowing today, but golf season's around the corner.
It
It'll be
is around the
Masters
corner.
soon. Yeah.
Totally.
Some people will recognize your voice, but I still haven't said your name. So it's Brandan Price.
Brandan Price.
Welcome back.
Thank you. Appreciate
Welcome
it.
back.
Thank you, guys.
Second or third time?
I think it's second.
Okay.
Yeah, but it's been a while.
Yeah.
Time flies. What's new? How's business for you? Obviously, up and down market, maybe down for the last few years, but how are you doing?
I can't believe it's March already. The sort of start of the year's flown by, but I'm seeing, people dust off the cobwebs a bit for the spring market, and sellers are getting organized to list, and, buyers are getting organized with their pre-approvals and, acknowledging there's value out there to do deals. So everyone's sort of getting organized in their respective fronts, and be interesting to see how the next couple of months plays out.
Do you think that the expectations of, as we move into the spring now, sort of concluding year 4 of this downturn, are sellers and buyers now materially recalibrating their perceptions and expectations about the market, do you think?
Oh, yeah, for sure. I mean, it's, in the heyday 2015 set to 17, and even, parts of COVID where it was really busy, you couldn't tell a seller the market wasn't very good. Even, at the start of COVID, there was a lot of uncertainty. Then things really picked up during COVID. It's now what I've found, which is great for buyers, is that sellers do not acknowledge that it's a good market. And it's been like that for a while. So you're not submitting a bid and they're like, oh, it's picked up and it's busy and, we'll just wait for the next guy. Those conversations that, I'm approaching 20 years in the business, hasn't happened very many times where the seller fully acknowledges that it's not their time. They know it's the buyer's time to shine. That's a big thing. It's helping buyers get price reductions, it's subject removal. It's just the seller knows that they need to be priced sharply, and that you could have 20 groups through an open house and get no offers. So it's, that's a big positive for buyers, especially those that are just entering the market or upsizing and with their growing families and things like that.
I think that's good for sellers understanding the reality of the market. Like, we haven't had a market like this in 20 years that's been sort of this slow from a sales perspective for this long. Prices have come down quite a bit over the last couple of years. So for sellers to understand that this isn't, a brief slowdown in 2008, this is something different, and to adjust their expectations accordingly, I think is really important.
Yeah. If you've ever owned any asset, right, and someone asks you, what's it worth? Like, you default to the highest value that you can recall. Like it sticks with you, right? Like you're not that willing, especially when it's a home where it is probably has the most value of any single thing in your portfolio, right? Like you are, we're all reluctant to sort of acknowledge that, oh, maybe it's worth $100,000, $300,000, $500,000 less than it once actually was. Even if you weren't ready to sell then. I mean, it was neither here nor there in a sense, but we get attached to those big numbers, right?
Pride of home ownership too. It's like
Yeah,
people should
sure.
value this as much as I do. This is my home.
Yeah. This is a great home.
And a big part of that, just, closing the loop on sort of where sellers are at mindset wise and knowing it's not a good time to sell. The BC assessment values help hammer that point home this year. I mean, obviously I haven't looked at everyone's assessed value. It's tough to do that, but the ones that I've come across, when you're looking at what they were in 2025 and then seeing what they are, have been now at the start of 2026, and then further reductions from there for these buyers and list prices lower, it's not a, blanket statement for every property. Some are still trading for above assessed, but the majority are trading for below assessed, and people seeing their property values go down 5 to 10% on their assessed value helps sort of create that mindset that I was mentioning to you of the sellers definitely knowing that it's not their market.
Yeah, absolutely. We'll talk more about the resale market in a moment. There's some mixed signals. I would say mixed signals coming out of the data in February. We also want to touch on some of the broader macroeconomic conditions as they've evolved to start the year. And that can't really exclude the war in Iran that's transpiring right now. We also want to talk about a few other things that we don't normally talk about, but it's your area of expertise where you spend a lot of time in the multiplex space, land assemblies, talking about pre-sale versus resale pricing, because that dynamic has changed
for sure
over the last little bit.
Absolutely.
So we'll get into all of that. But Mr. Wyse, I said there are some mixed signals coming out of the MLS data. I see two narratives, right? Like typically it's based on the first couple of months of this year. You see some commentary that is like total doom and gloom, markets collapsed, buyers don't want to buy, sellers can't sell, and values are dropping, and there's no hope. This isn't turning around. And then on the other hand, I've seen some commentary where it's like, you get some people really digging for those positive signs, right? Maybe digging a little bit too much. But I do think, like, on the surface, it's been a slow start to the year. February was definitely better than January, right? So the market, there's some seasonality there. But why don't you talk about how things have evolved to start 2026?
Okay, let's do it. So we do this every month, and every month it's like, how's the market? And for so many recent months, I kind of say like, it's more of the same. Sales are slow, new listings are up, inventory's high. And the sales are still relatively slow. You mentioned people getting ready for spring. We saw the seasonal pickup we would expect in February. So sales were still below average, just over 2,400 for the Vancouver region. That's the Vancouver board area plus the Fraser Valley board area. So that is 38% below average. So still pretty slow, but much, much higher than January. We didn't really get a spring market last year, so we'll see if we actually get one. Last year was all tariff threats and Liberation Day, and people just kind of stood completely on the sidelines last spring. But sales were still 8% lower than last February. So that's still pretty slow market.
Volume-wise?
Yeah, so number of counts. Yeah. So still a pretty slow month overall. What's interesting, though, is we had record new listings come to market last year. We hit 90,000. I don't know why I'm asking you. We hit yeah. So we haven't started the year off on the same trend. So we started off with the most active listings since 2013, and new listings have started to come off relative to last year, still higher than average. So new listings are actually down 10% month over month. So typically as we start the year, new listings expands, inventory expands. And so a January to February decline in new listings is actually quite rare. Instead, we're now seeing inventory kind of trend closer to last month last year, instead of expanding. And so the market's not more of the same. Sales are starting starting to pick up more so than new listings are. And we started the year with this like real buyer's market, and now we're kind of trending. The months of inventory has actually come down a little bit, and we could actually be trending back more towards balanced conditions if these trends continue. We're like a week and a half into March, and sales are just below last year for March sales, week and a half in, and new listings are like 38% below the first week and a half of
that's
last
significant.
year. So the trend now is not record new listings of so many people either coming to market or doing a price reduction, relisting, calling it a new listing, that little trick that some people do. And I think overall we'll see inventory expand more slowly than you might otherwise expect. It typically expands through the spring. So a lot of words to say the market has changed a little bit, but sales counts are still pretty sluggish.
And maybe that's partly due to everyone's calling their realtors in thinking like spring's their time. The realtor's doing an evaluation and like, oh, really? That's where my number is? It's lower than I thought. Okay, let's wait. Or let's see what happens, March, April, maybe reconvene in May. I'm having some of those discussions with sellers, people that don't really need to sell. That's just one, thought that comes to mind for me with people getting the real numbers from whoever their advisor is and pausing. But, the lack of supply is music to my ears. I think it does help things get into a more balanced position, and less for buyers to choose from can create sort of trickles of some partial urgency.
So I don't need specific numbers here, but what proportion of the market do you think on the sell side is homeowners who need to sell, like there's some urgency, versus not? Because the sense has been that even though we've seen prices come off, like we still haven't gotten back to the spring 2022 peaks.
We're further away than we ever have.
And we're
been.
further away. They're trending in the wrong direction. Given how much inventory is out there and how much sales have come off, it is surprising to me that prices haven't come off more, right? And we talk about this and attribute it to the fact that the economy, while not performing great, has held up. Definitely from a wealth perspective, you look at stock markets, other commodities markets, they've done very well. So this isn't a market that's characterized by economic doom and gloom where people, they don't have any money to pay the mortgage anymore, they have to sell. But what's your read on that? Like, to what extent do you have sellers out there who are like, yeah, if I get my price, great, and if not, I'll hang.
Yeah, I mean, at this moment in time, a lot of my inventory, on a percentage basis is estate sales. Someone unfortunately has passed away, and maybe there's 3 beneficiaries, and, it's been maybe a year or so since the deceased had passed away, and, everyone's looking to move on. Let's use an example of a property that's $2.5 million. And, there's 3 beneficiaries. Okay, well, yeah, they were hoping for 2.4 to, but if they get 2.3 or 2.2, everyone's still getting, that main bulk chunk of change, so to speak. So, it's, that's currently where I'm at with things is, a lot of people that are going to market this spring, at least in my own listing bracket, is a lot of estate sales or, restructuring with family and things like that. I've got a few other listings coming that fall under that bracket over the next couple of months. Investors are, if they have a vacancy in their condos, are entertaining the idea because they know that rents have softened when they're releasing it up. So they're looking at their numbers, hearing what I'm telling them their property's worth, and then, regrouping on their own or as a family to see what they want to do with, sort of the non-estate sale, just traditional investor condo resale product.
And certainly, I mean, it's an end user market right now. So selling a vacant condo versus a tenanted condo to an end user, the vacant condo is much easier for them to take possession of.
Yeah, absolutely.
Yes, I've repped very few investors over even the last 4 years. The numbers don't make sense. No. Even if you're buying a condo that's $600,000, to have it where you're flush with your expenses, you sort of have to be in and around 50% with today's rates and strata fees, insurance, property taxes. You tally it all up, you sort of need 50% down with today's rents.
Right.
That
And there's a
used to be
huge
35,
Right.
30 range.
There's a big opportunity cost there too, right? Of that capital being tied up there to make the return
Have
look
it be
decent.
Yeah, totally.
I mean, a lot of those investors were totally fine with that when prices were rising because they
Yeah.
could, count on that capital appreciation.
And they knew they could rent it out quickly, and there was less competition in the rental market and things like that.
Yeah. I mean, this is a theme of our market today, which is that capital, it flows, right? It's not constrained by, country, provincial, or municipal borders. It's not confined to an asset class. So, people are, everybody's chasing returns, right? And
Absolutely.
and over the past few years, we haven't seen that in housing. The West Side, did you want to share any numbers?
Yeah, for sure. So you obviously work quite a bit on the West Side.
Yes.
There's some interesting things I think that's happening on the West Side that's not happening through the broader market. On the sales front, they're actually outperforming right now, which often we think of the West Side as like a lagging market where, more affordable product picks up first and the West Side kind of picks up later. It's not really happening right now. So sales were just like 1.6% below last February, but actually like 1% above average. So sales last month on the West Side, a little bit above that past decade average, which I thought was interesting. Condos still way down relative to average. Detached home and townhome above average. And then skyrocketing because it's new product is that sort of duplex, multiplex space. So that bucket of home types is 171% above average for sales last month because everything's so new. Like 10 years ago, it wasn't a lot of duplex or multiplexes selling. And then on the inventory side, a little bit tighter, and then new listings kind of following that same broader market trend. So I think it's the family home, the end user product that's really sort of still getting picked up on the West Side. So I'm curious, like what
I
kind
can
of stuff.
attest to that.
Okay.
Yeah. So it's, I think a lot of people, let's say some of my clients that have been looking for a family home, whether they're renting or they sold and they're now renting, sort of been hunting for their family home. People are now realizing the time is now, or it's a better time than previous years to look at acquiring. And some of those people started their search around great East Side neighborhoods, Fraser, Maine, maybe Commercial Drive, and now they're looking at the pricing, chatting with their spouse and family and saying we should probably start looking at the West Side. We'd love to be there. It's great. The schools are great. They maybe grew up there at some of the local public or private schools, and they're looking at how tight the gap is. And, it makes sense to maybe if they do want to stretch a little or, look at different product in the West Side, it's appealing to a lot of people. If they're renting and or in their current property looking to purchase, and the goal for their family is to be in Kitts, Kerrisdale, wherever they want to be in the West Side, instead of going to something in East Van that they can afford and then going to that step, they'll save a lot of transaction costs with just maybe, biting the bullet, coming up with an extra 100,000, maybe selling some stock, maybe a small little injection from the bank of mom and dad. That's another thing. You're not seeing as much, or at least I'm not seeing as much of injections from the bank of mom and dad because of their assessed values, because their values
Because
are
of their
down.
own.
Yes,
Right.
because of the parents' values are down. They're not running around saying, oh my gosh, like place went from, in the great times 2.2 to 2.7. Now their place is closer to 2.2 today than it was at 2.7. So
And rates are
And
higher.
rates are higher, so
if
it's
you're
more
pulling it out of
costly.
your-
Absolutely.
And on the flip-
so
yeah.
I'm seeing these young families or middle-aged families, whatever that may be, making their own adjustments to make it work, because I'm not seeing the, bank of mom and dad come to property tours and look around and sort of verbalize to me and their children that they're willing to give them a couple $100,000. Obviously, there's people that are giving those funds still, but it's dramatically lower, the amount that they're giving, and, less families doing so.
Is the greater prevalence of duplexes part of it here too? Like, to get that sort of traditional family home, a little bit more affordable than the detached home, and you still get the yard and everything else.
But I would say, you know, not a blanket statement, just from some of my own experiences, let's call it younger families with no children, recently engaged, about to get married, or someone with one with maybe 2 children. A lot of them, even when you look at these west side land value, call it 33 footers entry point segment to the market, that's sort of, you know, sub 2.5, they'd rather spend maybe call it 200,000 less and get a move-in ready duplex. You know, I will say a lot of the, call it sub 50 demographic or younger families that are busy running their kids around to various activities, sports, parents are working, they've got mortgages to pay. They are trending towards these newer duplexes, acknowledging the value in those units from where they've, you know, some of those prices have come down 15, 20%. Front units were selling for 2.6 all day long. Now they're going for in and around 2.2, 2.3. The back units in, you know, I remember examples in Kitsilano were going for 2.7 for these 1,600 square foot units. Now those are going for 2.2, 2.3 in and around the pricing as the front. But I will say that these sort of younger families, growing families, are trending towards duplex because they don't want to get their sleeves dirty, roll their sleeves up, and, you know, get into these older houses that are essentially land value. They'd rather just walk in, figure out the GST negotiations with the developer seller, you know, and find some value in these duplexes and not have to do much, and still have a warranty with very low strata fees on these duplexes.
So let's just pivot into that.
Yeah.
And we'll come back to the newer macroeconomic data that we want to touch on, just because we're
into it.
We are full on in multiplex mode here.
Yes.
So just as background, the BC government in 2023 introduced legislation that sort of supported the growth in this space, the small scale multi-unit housing legislation, Bill 44. It essentially did away with single family zoning throughout the province, and
Exclusionary.
Exclusionary.
You can still build a single family
can.
home. It's just not excluded.
Yes.
It's only a single family home.
And you get, if you build single family, you're getting penalized slightly on your density.
Yeah.
Yeah, you are. Yeah. And I mean, yeah, now they're encouraging that lots be developed with 3, 4, 6 units or more. Depending on the tenure, if it's ownership, rental. So we would expect on paper, I mean, the idea there is that we're activating sources of supply that otherwise wouldn't be available. Like the view has been, I think the city of Vancouver, like 65% of the land base is RS1 or single family zoned.
That's like all land. That includes roads, hospitals, parks, everything.
Yeah. So it's a significant chunk, right? So the idea is let's unlock that and allow for the housing market to evolve in line with the needs of people and what they can afford. And so, you know, since it was introduced on paper, I've supported it. I didn't personally see it as a silver bullet.
Yeah.
Right. But we are, from a transaction perspective and a construction perspective, we are seeing big growth. I mean, Rye, you just pointed out on the west side that that multiplex segment saw sales increase, you know, almost triple over the past year.
Decade
over
average,
the past versus
decade
the past decade average, but a big increase. So why don't you talk a bit more, Rye, about what we're seeing more broadly in that segment?
Yeah, so it's still disproportionately within the city of Vancouver. So about half the starts, if you look at CMHC housing starts, about half of they call it semi-detached. I call it an Ontario term.
That's it. They call it semis in Toronto. Some of my clients that are coming have told me that they call them semis and not duplex.
They don't consider it a duplex unless it's stacked on top of each other. Anyway, it's a point of contention with me. So about half of the semi-detached starts across Metro Vancouver are in the city of Vancouver. We're in the city of Vancouver last year. It's a growing share, but a small share of the overall amount of construction activity. There was about 1,500 starts across the region, so over 700 of those in the city. That is like 6% of all housing starts were plexes last year across the region. So still pretty small, but it's growing. And that's I think the only sector that actually saw growth. Condo starts have come down. And so there's more than 500 applications ongoing in the city of Vancouver. Half roughly have a development permit. Many of those are applying for building permits now, so pretty close to starting construction. So, it's big in the city, it's growing in the region, but it's still a relatively small share. And back to your point, Ryan, about is this a silver bullet? I mean, if you take a lot with one house, or maybe one house with a basement suite, and you build 4 homes, you're getting, +2 for every one of these. So it's not like a tower or a big townhome development where you're going to be adding hundreds of homes. We're talking about incremental increases, but spread out across an entire city or across an entire region.
And to that point, it's a form of housing that you're simply not creating when you build towers.
Yeah,
right.
Absolutely.
And so that people like, young families like.
A young family would way rather be in a duplex or multiplex versus, have a kid or two up in the 20th floor of any building, sort of anywhere.
Yeah, absolutely. Yeah, I mean,
in
it's
an ideal
intuitive,
world.
right? In an ideal world. So, some questions for you about the space. I'm curious because I know when the legislation was initially introduced, my perception was that the concept was often framed around this idea that, like, as a homeowner, you can realize additional value in your property, still have a place to live. So, like, downsize the home that you live in, but stay on the lot, and then build around you and, realize that value there, but you don't have to move. And
except during construction.
Yeah, no one likes that.
Yeah.
But as an end state,
Yes.
it's like, okay, yeah, you can see how there would be potentially, additional value accruing to homeowners. But, like, how much of the capital that is driving this comes from, like, the mom and pops versus being professional capital, small developers, family offices, that kind of thing?
I feel that initially when everything changed where you could do multiplex, because obviously you've been able to do duplex for a little while now, it's just sort of talking about the multiplex. I had quite a few clients reach out, or, sort of the younger generation reach out on behalf of their parents. And candidly, I told them to not do it because, it's different if you're a developer building duplex, building sort of smaller scale developments, and you've got economies of scale with your trades and those types of things.
So, like,
but even if all 3 of us here, took one of our houses and did that, when you look at sort of today's current revenue sales figures on these types of units, all 3 of us would lose our shirt. It's just because we've got to pay retail numbers for architect, builder. None of us, it'd be great if one of us were a builder and had reduced costs. And obviously we could all call in a few favors. But when you look at what our all-in hard and soft cost numbers would be to build these things, they're a lot higher than what someone that's building 15, 20, 30, call it, doors a year.
Right.
That's a big thing. To me, it comes down to what's your construction costs.
Right.
Because when you factor it all in, some of these people, the mom and pop type that might have entertained it, they might end up be in a better spot to sell their house, rent, and wait to pick up something that's built and, get one of those units in one of those developments.
Right.
I just think that most people, the mom and pop type folks, not because of lack of experience, because they could get advice from myself or their advisor, but I think it's just hard to make the numbers work on a retail level for people that are only doing that project in the course of a year.
And then what do you think? You said construction costs are sort of, for you, the biggest nut that needs to be cracked there, which makes sense. But what about land costs? Because one of the, I don't know if I call it a concern, but reservations maybe I had about the efficacy of the policy as it relates to, like, expanding supply has been around, like, where do those opportunities exist for this type of redevelopment to actually take place? And I thought of my own situation, right, where I'm raising a young family, and the amount of money that somebody would have to offer me to acquire my property to redevelop it would be prohibitively high, because I'm not interested in taking 20% more than market for the sake of it, and then being spit back out and needing to find a home to raise my family in again.
Yes.
Right. So it's like, I would think, but you tell me, like, do we see, like, how much are land costs prohibitive in seeing more development in this space? And do you see, where we do see these multiplex coming up, are they specific circumstances, like older couples or families that are looking to downsize, get out, or maybe their estate sales, or what do those look like?
Yeah, so the ones where you're seeing multiplex built out, I think you're seeing them on sites that might be a B plus, not an A type site in most cases. There are sort of developers, household names, just for confidentiality, I won't mention their names, but household developers that have been doing projects all over have taken a bit of a position in these multiplex. I've seen them even take a step back on land acquisitions. The reason why I mentioned construction costs and didn't really touch on the land is because, from a 10-year land price horizon, let's look at the west side, prices are quite reasonable. Yeah. So to me, it's like, okay, yeah, would it be great to get your land for $100,000 cheaper or $150,000 cheaper on a 50-foot lot? Yeah, absolutely. But you're going to be able to make up that little gap by, let's say a group that's got economies of scale that are, again, the groups that are building 15, 20, 30 doors or little projects here and there. They're going to spend less on construction than we all would. They're going to be, call it in and around, their all-in cost might be $350, $400 a foot. We go out there and do the same thing and we might be at $600. So when you look at the $600, it better be quite a bit nicer than the guy that's building it at $200 cheaper than you.
Who does it professionally.
Yes, who does
who knows what they're doing
it day in, day out with a gauntlet of 50 trades that are, doing stuff quickly. They're building it quicker than we would, which saves on lending costs. So I don't think it's really, the land pricing. I think it's really comes down. That's why I sort of leaned in on the construction costs and the other soft costs. Some of these developers may not hire a designer, where we all three here would, because we're not doing that, but they're doing more scale. They might be on their third duplex or multiplex project, and they've got a designer that's doing it sort of on a lower price basis. And again, the economies of scale for these groups. So $200 a square foot. When you look at the 1 FSR density on these multiplexes, what is that? Call it on a standard, or call it on a 50-foot lot that's 6,000 feet, $200 a foot. What is that? Is that 1.2 or no, it's 120K different. I got to work the numbers. My calculator's not out here today on the podcast.
That's 0.3 extra.
Computers for this.
Yes, exactly. Yes.
But the point is it's a lot more for the retail folks to do it.
So are they generally then not knocking on doors and trying to select high profile sites when, like you mentioned earlier, that the older homes that need a lot of work are kind of not really attractive to the young families? Like, there's probably a lot of listings of older detached homes that are like just available. Prices have softened. You can negotiate a decent deal. Like, they probably don't need to knock on doors right now.
No, you can seek what's on the active, MLS and sort of pick from those. But when there's a restricted supply situation, guys are knocking on doors to do these multiplex. And, I'm sure we'll get there again, but it might be a little bit.
It's about another $350,000.
Okay, there we go. Thanks for crunching that, Ryan.
On a 6,000
so you look at that,
lot.
if the lot comes down 100, and that's just like general rough numbers. And so it just gives you a feel for, what the developer crowd is spending versus mom pop / people that want to give it a go on their own to end up living back on their single family lot. I think they're better off just buying existing new product than becoming a developer. Because the other thing you look at, $600 a foot on a 6,000 foot lot, you're looking at 3.6 million of construction costs,
Yep.
plus your land cost at, call it $3 million plus or minus. That's a $6.6 million project. Should those mom and pop folks that pretty much have all the money in their house, they might have some stock accounts and have some other money. I'm just talking general broad strokes, the bank of mom and dad type crowd. A lot of their equity is in their house. A lot of their net worth is in their house. Do they want to turn around and be a developer and do all that and have the stress? And, they might have some general development experience, but they're not ready to really maybe take that on to then come out of it and maybe lose 500 grand when they're done the whole project.
Right.
So anyway.
Great insights.
Yeah.
I mean, it's a space that we don't spend a lot of time in. It's an emerging segment of the market, right? So this is actually very educational.
What about doing a deal with a developer as the seller? So you negotiate in that you're going to buy back one of the units. You're not actually going to develop it themselves. Developer essentially pre-sells one of the homes up front when they acquire the land. Maybe there's a deal to be had.
There's some benefit. Yeah. You'd have to figure out and structure how that seller would vend in their land. And, there's ways to figure that out.
Yeah.
But again, as the seller that needs to start off this whole party with the developer and figure out where you're going with it, when they actually look at the numbers or they get an analyst or a realtor to crunch those numbers, they might be better off staying in their house or, again, buying the multiplex that was just built 2 months ago down the street. The only caveat is for someone that to do multiplex is if they have a large family, they've got a family property, the parents want to downsize, the kids might be having a little bit of a tough time entering the market, and they all throw in sort of their equity together. Maybe they do build at 600, or maybe they're all in for 500 a foot. I'm talking hard and soft costs here, to then all land and sort of cohabitate, so to speak, and have some built-in childcare and all live there together. That might make sense. But to go to market and sell from being a mom and pop owner, I think you really want to nail down your numbers and get clear on what the end revenue is.
That would be daunting for the vast majority of homeowners. Let's pivot back quickly.
Sure.
You had a few comments on the latest. This is a hard pivot. This is just like no smooth segue out of this. Back to the latest inflation and jobs data and what it means for this market potentially.
We've been saying for a couple months now, kind of, that inflation is something we don't have to worry about. So we've been inside the Bank of Canada's target range for more than 2 years now. The Bank of Canada has lowered their policy interest rate to 2.25%, and they've said they're going to hold there. And one of the things we've been saying is, inflation is not our concern. Our concern is a whole bunch of other stuff, a lot of which we've talked about today. So now we've got a new war in the Middle East. Oil price basically doubled in a couple weeks. They've come back a little bit. If this is sustained and the oil shock remains, that will be inflationary, and that's something the Bank of Canada will have to deal with. Probably not in their next interest rate announcement, but this is something, a new concern.
Which is in March.
Yeah, this month.
Yeah.
So this is a new concern that we just didn't have before 2 weeks ago.
I think it's a real concern. I mean, I think some of us are looking at the this latest oil price shock as something it'll go away. There's some evidence that it might play out that way. Oil prices, like WTI crude, was $65 a barrel prior to February 28th when the war began. It touched $115 a few days ago. It's now receded to $85. So if you look at where the pre-war value was, where we are today, obviously the current number is in flux. It's up 30%, right? So there is, like, any gas station you drive by, you see that the price of gas has gone up materially. Like we're now approaching $2 a liter here, right? So there's that mostly direct pass-through of higher oil prices into gasoline, just the cost of operating our vehicles. But then you step back and you realize like how pervasive that is, because our economy is predicated on moving people and things around, right? So all of the things that we buy everywhere, to the extent that higher oil prices prevail, are going to have baked into them higher input costs,
Especially food.
So especially food, but literally any physical object, right? It gets moved around on something with wheels, typically, right? And so there is a risk here. The question is like, how long does this war go on for? None of us here are going to be able to predict that, so we don't need to speak to it. But it is interesting and unfortunate that inflation now, we can't just dismiss it and say, hey, this is not a thing.
Like it's something sort of went away for a bit, and now it's.
I mean, underlying inflation. So if you look at, broadly speaking, outside of, I think, food inflation we've seen some acceleration there, but generally speaking, core inflation, headline inflation has been, as you said, under control for a couple of years. There's no real threat to broad-based price increases outside of what we're seeing in oil. And so to the extent that the conflict is resolved and comes to an end in the Middle East in the near term, we should expect. I mean, oil is flowing through the Strait of Hormuz. Right now, it is not. The number of tankers that are moving through that part of the world has dropped from, I think it was 60 per day down to 3 to 4. I don't know who those folks are that are, who they're risking life and limb to get through there, right? But you would expect traffic to normalize to a degree, right? And so, maybe we just end up back to where we were in February in the near term, but now that variable is in play.
I'd like to talk about immigration at some point.
You want to talk about immigration?
I mean, I don't
lead the
have
charge.
I don't have any. What I'm seeing is, and you guys are obviously looking at the numbers way closer than I am, but you look at, we're sitting here, we're looking at Sanok. I believe Rennie's doing the lease up there, and just other rental supply, the unsold finished new product, developer space. I'm personally on the streets hearing, people sort of leaving the province, not in droves, but, people are going to Calgary. Maybe if they're from Toronto, they might be going back. Not hearing of a whole lot of an influx of people coming. I again, not tracking student visas and, total folks coming in from international cities, but wondering if you have any sort of broad general comments about that. Because it's, when you look at standing built rental inventory that needs leasing up, and you look at the unsold developer product that's obviously been a hot topic here at our office, just given what we're involved in, would like to know what you guys are seeing, what you're sort of hearing out of Ottawa, if anything, in the province. Because, to me, it's, where are all these doors going to get filled up from if immigration has essentially stalled, from what I'm hearing out there.
So it's something that we've talked about on the podcast before, and we sort of touch on as new data emerges.
We'll get the Q4 update any day now. It's coming from StatsCan.
Okay.
And it will show likely population loss in BC, almost certainly.
For the calendar year 2025.
For the calendar year 2025, and probably nationally.
What's important, so you're not, your assessment there, your take is consistent with what we're seeing. In our view, the demographic, the change in the trend in population growth, which has gone from positive forever to negative, is most certainly transitory, driven by federal immigration policy, specifically as it relates to non-permanent residents, because we're still welcoming close to 400. The target is close to 400,000 permanent residents.
And so when you look at it provincially, we'll have a net inflow of immigrants and a larger net outflow of non-permanent residents. That kind of overwhelms that number. So we're still bringing in immigrants. We're essentially asking a whole bunch of temporary workers and students to leave.
But this is, there's,
okay.
There's an end date for this, right? Which is the end of 2027. And so to the extent that immigration targets are achieved by then, we fully expect, like the math just dictates that we get back to historical growth levels, adding in Metro Vancouver, between 30 and 40,000 people on a net basis per year.
See that being added back in again?
The only way it doesn't, there's a bunch of ways it could evolve, but realistically, The only way we don't get back there is if the policy is extended, amplified, a new policy restricting incoming people to Canada is introduced. So, if we look at the existing set of policies and the perspective that the federal government has on immigration and the value that immigrants bring to our culture, our economy. Yeah. I mean, starting in 2018, we should be back on, this is very much a temporary blip. Yeah. So you're right. Right now,
2028.
2028 is the year when we should return to historical growth rates. And, what it means is.
And that's right when completions should really slow down. So
that's true. And
it could be, yeah.
You're right that there's a glut of rental housing right now. There's a lot of completed and unsold developer-held inventory that will take some time to work through. It's why, when we advise our developer clients, when we speak broadly to the rental market, it's going to be softer. We've had 2 years of declining rents in new product, right? And we think that that's going to continue this year. I mean, it's bringing together more sluggish demand and a lot of new supply, and that needs to resolve itself. It doesn't happen overnight, right? So Absolutely. It's also not that far off in the future. So we think this cycle bottoms out next year, and then we start to return to normalcy, assuming the rest of the world hasn't gone crazy.
Who knows? And then on the interprovincial side, it was a negative interprovincial migration for about 18 months. So that's more people moving mostly to Alberta than coming from Alberta, Ontario, and other provinces. It flipped back to positive, really small positive numbers, I think Q2 of last year. We're probably trending towards small positive net interprovincial migration last year once we get the data. So like a few thousand more people will have had come in than did leave. Yeah, it's a lot of words. So it not a major source of population growth, but no longer a source of population loss. Yeah. And I think part of it, so many people left for affordability reasons, and now all of a sudden we've got this soft rental market. If you're 22 and working and rent is coming down, then it's no longer like, I should probably move to Calgary. Like, hey, I can find a decent place now. Whether it's in the newer rental space that has a ton of vacancy, or in the older rental space that's starting to free up a little bit as people move within the market.
Yeah. Satisfied?
Yeah, no, I appreciate it. Yeah. No, it's, I think it's a big, it has been a key market driver and, one of the fundamentals of the market. And I just wanted to get some clarity on that. And hopefully the people that are listening, appreciate that intel as well.
Yeah, but I mean, like to this point as well, it does, there is a window here, an opportunity again, if you're in this market, or if you were already planning to come here, whether you are renting or buying, you've got conditions that still tilt favorably, in your direction,
for the
right?
new market entrant, whatever that may be. It's one of the first times I've seen this ever on a sign. I was driving in the West End. It's again, I won't mention the site, but it's a prominent rental site, multi-tower site, sort of older product. There was a big lit up sign, like a nice sign. They probably had, no vacancy on showing there previously, and it, referenced incentives. Yeah. And I mean, it's I should drive back today and see if that's still there when I'm heading downtown for my next meeting, but you don't see that. So as the tenant that's complaining about, lack of inventory, the tenant's got to be, grinning a little bit as well.
Oh yeah, absolutely. So there isn't a project that's a rental project that's launched in the last year or is leasing up now that isn't offering incentives.
For so long in this market, we didn't have nice new rental for people to live in with amenities and all the bells and whistles. If you want to rent a nice apartment right now, you have so much choice. They want you to come. They're offering incentives. Like, it's a great time to be in that space as a tenant.
Let's wrap up here with our listener question. It's Marcus from Pemberton.
Hi, Ryans. It seems like a lot of home buyers are still holding off. What do you think they're waiting for before making a move to buy?
Well, they directed it at one of the Ryans, but I think this is a question for you, Brandon.
Buyers, and I've said this to a number of people, it's over the last, call it year, 18 months, plus or minus more specifically, buyers have been rewarded to wait. let's say they started their search 18 months ago. You look where things were at, 6 months into that, then another 6, and then another 6. Now you're at today. The pricing slid down. They started watching it when prices came down in Vancouver. Historically, prices aren't coming down that much.
And rates came down at the same time.
And rates came down as well. So people, I think, waited for the rates. They saw prices come off. They were incentivized to wait. And, no one's got a crystal ball, but as a buyer, when you've got a seller that acknowledges that it's not a good market, rates have come down, you've got your down payment, you're in a strong position to negotiate, especially if you're currently renting, have sold, or, don't need to sell to acquire. You're in a good spot, probably the best spot over the last 10 years. Buyers should be the one guy at, that dinner party that's putting their hand up saying, I just bought recently. And, Bob has mentioned it before. I've been here a lot, so that's why I referenced that dinner table discussion, socializing and being the fact that in a hot market, those 8 people are sitting at the dinner table, maybe 4 of them bought within the last couple of months. They're all happy saying the market's busy and I bought, but really they shouldn't be buying in a market that's, or be happy with the fact that they bought in a busy market. I think a lot of buyers are, for the bulk of them, without their realtors, are slightly uneducated. So, them buying into a busy market almost gives these buyers a bit of confidence, is what I have personally seen just out there in the field, where now no one's buying. The herd mentality is nowhere even close to being prevalent. So they'll just maybe continue to wait a little bit, or wait to tour till after spring break, or the urgency is not there. I will say, we've talked about, how it's dramatic buyer's market. I have seen more activity just, in certain segments this year than the end of last year. I know we haven't brought a whole lot of positivity to sort of this podcast, but I have seen a number of multiple offers for, let's say, those families that might be going from a 1-bedroom or currently renting to then buying, call it family-oriented product at reasonable pricing. So let's call it product that they could, do some touch-ups, whether it's do it yourself or a little lipstick or, cosmetic reno, call it sub 1.5. You're seeing some activity because buyers are seeing value. But I think, the herd mentality, whether it's Bitcoin, Labubu's, stock, real estate, buyers, people, they sort of like to join that herd. So right now, there's none of that. So they just continue to push that can down the line and wait. And maybe when you see that herd, it could be a larger herd than we've seen before. I don't know.
I think the herd mentality is still there. It's just the herd thinks it's a good time to wait.
Yeah, I mean, the reason a first mover advantage exists is because there's a first mover fear, right? And so that's what we're seeing right now.
Yeah.
But the reality is that housing is, as you said, it might be the best time to buy in 10 years. And housing is objectively, like whether you're renting, but particularly if you're looking at ownership, it is more affordable than it's been in 4 years. Great. I want to wrap up. We always love to answer your real estate questions. You can email them to us at intel@rennie.com or leave a voicemail at speakpipe.com/the Rennie podcast, and we'll try to respond to it on the next episode. Before we wrap up, final piece of advice. I know we've run long. We have not talked about land assemblies. We didn't talk about pre-sale, resale pricing. So we'll have to have you on again. But
Absolutely,
as we ride out here, final piece of advice, and then and how can people get in touch with you?
Yeah, so I would say, for buyers, if you have been looking and you're sort of waiting for prices to come down, they've sort of come down a decent amount. get your pre-approvals, chat with, whether it's me or whoever your real estate advisor is, and see where you can find your fit or your family's fit in this market. I think it's, something worth considering given sort of the state of the market and the overall seller's mindset. Again, Brandan Price, leader of Team Brandan Price. You can reach out to me at bprice@rennie.com or on my cell phone, 604-765-9555. And happy to have a chat or a coffee, talk about what in depth I'm seeing out there.
I love a man who's not afraid to share his phone number on a podcast. Thanks for joining us again, Brandan.
Is that unconventional?
Hey man,
You're
it's
not the only
it's-
one to do it. but
Everyone
not
rolls a
everyone
different way.
does.
Yeah. It's your phone. Thanks for joining us.
Yeah, thank you guys.
It's been a pleasure.
Appreciate it. Thank you.